Well, let's stay on the market. As uncertainty over tariffs and fiscal policy continue, our next guest expects a slowdown in economic growth and higher inflation in the second half. So joining us now is Wells Fargo Investment Institute Head of Global Equities and Real Assets, Samana. Samir, it's great to have you on. Let's start right there, because we have seen a slowdown in economic growth, but we are also coming off of years of record fiscal stimulus. So how much of this is just normalization, and how much of this is the calm before the storm of something perhaps more pernicious?
Yeah, Morgan, great questions. And honestly, we won't know until probably Q3, maybe even Q4, because right now there's a lot of front loading of inventories. There's probably a lot of purchases on the part of consumers to kind of get ahead of those tariffs. So we won't know what the actual run rate of the economy is probably until Q3 or Q4. Now, we will go ahead and say, look, we don't expect a recession. So while it will be slower, it's not going to be recessionary, but it will be probably a little bit, again, to your point, not as strong as it was over the past few years, which makes the economy a lot more vulnerable to a shock. So that could come from geopolitics, could come from those long rates, could come from tariffs. And I think that's what worries us, is just the fact that we are heading towards stall speed.
So in light of that, how do you protect yourself from being vulnerable? Where do you invest in this market right now?
So we think you can still pick up 4 to 4.5%, kind of in the short to intermediate part of the fixed income curve, and we wouldn't take on too much duration at this point, given some of the factors going on there. So, what we would do is probably rebalance at a high level from equities into fixed income. If you have, over allocations to areas like small caps, like emerging markets, we would probably pull back there first, just because of the lower quality and the fact that they're more economically sensitive, especially in any kind of pullback.
Samir, we went from equities, from stocks, reacting to the Fed for a couple years up to last year, and then to policy this year. How long does that back and forth between reaction to Fed and policy continue before something else kicks in?
Yeah, look, I think we have moved on really from the Fed to tariffs right now. I think the blow by blow of tariffs over the next few months really will be probably the primary driver of markets. I think the Fed is telling you again and again that they may not cut rates this year. We only expect, a few between now and year-end 2026. So really, that's not the main driver for markets. The main drivers will be tariffs. And then I think, honestly, what will happen with corporate earnings? Who will actually pay the cost of the tariffs? We believe tariffs are taxes, and somebody has to pay them. It's some combination of U.S. companies, U.S. consumers, or international producers and the people making the goods.
So are there stocks, are there industries that are sheltered enough from the tariffs themselves that you feel confident placing bets there that sort of aren't as dependent? Or does the entire global economy hinge on this tariff question so much that there's nowhere to hide?
Yeah, I think in early April, it was pretty clear to see that tech had probably sold off too much on some of the DeepSeek news and on some of just the lower glide paths from an expectation standpoint. Now you've had a very nice rally. So I would say from a timeliness standpoint, energy jumps out to me, still very cheap, not as impacted by tariffs unless there's a recession. Financials, very domestic industry, should see lower deregulation, is enjoying kind of that steepness in the curve. So I would say that's probably an opportunity. And then mid-cap equities. We wouldn't go too far down the market cap stack to small caps, but we think mid-caps are in a little bit of a sweet spot if things come back to the U.S. in terms of manufacturing and production, but also from things like M&A, which could pick up later this year.
All right.